right, folks, this is Vishal from Equity Guru, and let's talk about what is going on with the stock markets. It is summer. It's been a bit quiet here and there, but we still keep getting fundamental news, which is weighing in, I guess you could say, on this major uptrend here on the stock markets. And we'll look at the technicals in just a bit here, but some fundamentals that I'm watching. We've talked about recession warnings, we've talked about inflation, we've talked about the soft landing, the interest rates, the Federal Reserve. Is the Federal Reserve near the end of rate hikes? Are central banks near the end of rate hikes? There's earnings, there's some geopolitics there as well. And just recently, we got the banks making headlines again. If some of you remember, there was regional bank issues a few months ago. Actually, there was a major bank as well, right? Credit Suisse, which got rescued by UBS back then as well. And a lot of people were talking about, contagion and if the banking systems are going to get affected, etc. Another major financial crisis. A week after Fitch downgraded U.S. credit from AAA to AA+, Moody has cut the Moody's, which is another rating agency, has cut the ratings of about 10 U.S. banks. Some big names, Bank of New York Mellon, U.S. Bancorp, there as well. And then there was also an outlook to negative for 11 banks, including Capital One, Citizens Financial, and Fifth Third Bancorp. The reason, higher funding costs, interest rates are quite high, potential regulatory capital weaknesses, and rising risks tied to the commercial real estate loans amid weakening demand for office space. And this is, something we've talked about in previous articles and videos before about the bank's major businesses, lending money. And when rates are high, they don't tend to do so because people wait it out. And obviously, this is what the rating agencies, or Moody's in this case, is seeing. They talk about a lot of Q2 earning results showing profitability pressures that will reduce their ability to generate internal capital. The agencies also believe interest rates are likely to remain higher for longer until inflation returns to within the Fed's target range. So, this is ongoing debate right now about, the Fed is maybe done, but then a lot of people claim that the Fed's going to start cutting rates because of an economic slowdown. And then there's another camp saying, no, don't expect that. Rates are going to be high for quite some time. Contradicting evidence, with the labor data as well, showing maybe the economy getting a bit weaker, but then you have like GDP coming out higher, saying the economy is not weakening. But these agencies expect a mild recession in early 2024, given the funding strains on the U.S. banking sector. There will likely be a tightening of credit conditions and rising loan losses for U.S. banks. So again, folks, higher interest rates going to lead to a recession, leading to U.S. banking sector getting a hit because of credit conditions and rising loan losses. And they also talk about a worsening in asset quality is on the horizon, which I think is quite interesting, just because they talk about a lot of analysts are concentrating on the interest rates and the funding part of things, but a worsening in asset quality. I think that's something that is worth noting from the statements that Moody gave here. So, we have the banking stuff issues again, making headlines once again. So we'll sort of see how this develops. And I talk about some of these ETFs here, KBE, XLF, which are like the banking ETFs and financial ones. Keep an eye out on those, see how they react. But you can see here, they've still sort of been ranging, no really major breakdown after that major headline news. So far, I guess so good in the technical indicators. But I think if this fails, it wouldn't look too good. And funnily enough, we'll take a look at the S&P 500 chart here in a sec, but you'll sort of see the same market structure that we are seeing in all the equity markets there. If we talk about inflation numbers, we see U.S. wholesale prices rose 0.3% in July, which was higher than expected. The PPI, which is the producer price index, rose 0.3% for the month, which is slightly higher than the 0.2% estimate. We got CPI inflation coming in at 3.2% annually in July, which was less than expected, but was higher than the data that we got a month ago for the month, right? The previous month there. So it's showing that there is some sign that inflation is losing its grip, I guess, on the U.S. economy there. If we exclude volatile food and energy prices, core CPI increased 0.2% for the month there, and you can see here like that little uptick. That's what we were talking about. So that 3% in June, that was the CPI there, and now it's a 3.2%. So lower than expected, but higher than the previous reading there as well. So obviously, the analysts saying, okay, maybe the Fed might still raise interest rates in September, but that might be the last one. So we'll see what the Fed says, right? A lot of people are seeing this as a good sign, but I think you got to remember that 2% is the threshold. So if they don't keep raising rates, then they'll keep those rates, higher for much longer and be more pragmatic. Like look at the data as it comes, see where that inflation is going, and then decide to raise or don't even think about cutting, I think, this year, right? But think about that next year if we go into some sort of mild recession there as well. And then you have other, headlines saying that U.S. inflation ticks higher in July. But again, this was what I meant by June inflation coming at 3%, July coming a bit higher at 3.2% there as well. So let's keep an eye out on, that data points there as well. I wrote an article about the Bank of Japan and how they, tweaked their yield curve control policy, allowing yields to go on the 10-year up to 1%. But then subsequently, when rates started to rise, they did intervene and bought bonds to tame that rise there. So we've talked about this many times in the past, but keep an eye, on those bond markets, right? The yield on the 2-year, the yield on the 10-year of the U.S. And, with the policies going on with the Bank of Japan, I would watch what happens here on the 10-year JGBs as well. But if these yields, if they do break out here above this level here on the 2-year, above 5.08%, I think there'll be some pressure, for the markets. And I think this is interesting that we are sort of in an uptrend here, beginning to range here. But if we do get that breakout, I do expect that markets will also fall lower as well. Interesting move here on the 10-year with a nice recovery after a bit of a pullback here. And I think I should mention that Bill Ackman, right? He actually is betting, and he's got a short on the 30-year government bonds. Again, the bond prices, betting on the 30-year yield to increase much higher. So he's actually expecting that this will break out. So yields will actually go higher. And I believe his target was about 5.25%, if I remember correctly, on the 30-year there. So, keep an eye out on these yield markets here, because I think those will definitely impact what we see on the equity markets. Let's break down, the charts here quickly. We've talked about all these markets in previous videos where they broke out above this level here, the 4150 here on the S&P 500. We had a very nice uptrend, just higher lows, higher highs, higher lows, higher highs. And then we began to range and stall even after a breakout. So this is quite interesting price action. You see a breakout, you see a close above previous candle highs, but then the sellers come in with force. So you got a false breakout or a fake out, and that's usually a very good sign that the momentum is shifting and the bulls have been trapped. And the bears have come in and put their they stepped in hard and have taken out all the bulls there, right? A lot of the bulls probably have some stop losses here. That also helps out with the momentum to the downside. But we've talked about this even on the our Discord group there as well with this breakdown here. This is now the next resistance level we're working with. We've even seen price retest that level, saw sellers step in. So as long as we remain below this 45.50 zone on the S&P 500, there is chance that we are going to head down a bit lower. And we're looking at this 4,400 zone first. There is a bit of support coming up here, but I would like to go 4,400 just because if you do a nice line chart, I think you can connect the dots a bit easier around this zone. And we just try to do that with the line chart to get these major support levels there. And again, folks, this could just be a little or one initial pullback in the overall uptrend. But if we do take out these 4,400 support level here, then I think we should be wary for a bit more downside here to that 4150 or 4160 zone here as well. You guys all know about trend lines and slopes, so a lot of people have been looking at this type of trend line. I guess you can even draw one here if you want to connect just these highs here, but you can see how even the rejection on the retest applies to this trend line as well. So it sort of adds to the bearishness sentiment there as well. So I see some weakness here in the markets unless we can reclaim this 45.50 zone here, as I said before. Very similar approach on the Nasdaq, although this one has a much more nicer double topping looking pattern where it just looks like an M top here, the letter M. We got that breakdown, we got the retest, and the sellers continue to pile in, and we will look at around the 14,500 zone for the next level of support. But you can just see the shift here a bit more clearer. You went from an uptrend with higher lows, higher highs, to a range with this double top pattern. And now the question is this just a retracement or a corrective move, or are we now going to be making lower highs and lower lows in a new downtrend here? So same analysis, unless we take out this 15,430 level, it does look like the Nasdaq will be under some pressure. And then you have the Dow Jones, which is just not really doing much. It is just a bit more choppy here. It did sort of regain a broken support level, but now it's not taking out these previous highs. And I think this is interesting just because the Dow is what you tend to see foreign money run into, just because a lot of these companies are, large dividend paying stocks. And, I guess even for safety as well, right? If you want to get some sort of yield or return on your money, I think people might look at those dividend paying stocks, right? Like how popular those value stocks there. So the action on this market has been choppy for quite some time. We even talked about this big range here, really doing nothing in a range here as well. But yeah, I'm sort of looking at the Dow as more foreign money and maybe safety, whereas the Nasdaq is, mostly like the retail crowd, right? Because you have a lot of the tech stocks and like the Teslas, the Apples, your growth stocks. And then you have your S&P 500, which I like to sort of consider as like the domestic U.S. market, right? Like funds and big money domestically in the U.S. there. So I'm not saying that's correct. It's just the way I like to sort of look at price action here. So, in summary, we have all of this data here, which is, there's just so much information, right? I get that question from traders all the time here. Recession, interest rates, Fed rate hikes. If the Fed is done, then the stock market's going to go higher. But wait a minute, if there's a recession, that means the stock market's going to go lower. But the Fed might not, raise interest rates anymore, and that's going to be bullish for the markets. So there's a lot of, data and conflicting data here going around, and I think sometimes it's worth just looking at the charts in terms of just market structure. Are you in an uptrend? If you are, you don't short, right? You continue to buy until you see signs of that uptrend being finished. And as I said, on the S&P 500 and the Nasdaq, there's a really good chance that might be the case here, because we have shifted from higher lows and higher highs to potentially our first lower high and lower lows in the beginning of the new downtrend there. So in summary, the charts are showing there's some weakness going on, and I would really, really be watching these bond yield charts at the 2-year and the 10-year and that 30-year. As I said, if these do break out higher, then there's a very, very good chance that we're going to see some more pressure on the equity market. All right, folks, well, that's it for me. If you enjoyed the video, please do give it a thumbs up. Be sure to subscribe, and I'll see you guys all in the next Chart Attack video.